The next topic I want to get into is index selection. Now, you might be thinking, why does that even matter? Index selection matters because when you're building stock returns, it can have an impact for certain metrics. For example, it changes your covariance and your beta, and that changes the asset rankings and the grades that we would assign them. The metrics that it impacts are beta, alpha, trainer's measure, and R squared. And if we take you through the math, starting with the index's expected return, the expected return flows into the asset's covariance, down here in the purple box, and then the covariance flows into the beta, as well as the R squared. Then beta flows into alpha and trainer's measure. So as you can see here, by changing the index's expected return, that flows through the different metrics and can have an impact on our stock selections. So what we wanted to determine was, did that make enough of an impact to matter? Since we were already testing a number of other theories, we wanted to go ahead and see if changing the index would impact our overall returns to see if it's worth considering as part of your investment strategy. This here is just a representation of how indexes have performed since the beginning of 2008. And 2008 was a tough year, but markets do experience losses like that, and you need to be prepared for it. That said, over a 10-year period, the market does tend to perform at a high level and has almost always produced positive results. You can see here the market actually performed quite well over this time, and a few indexes performed at very high levels. Mostly those were the ones that were associated with technology stocks, and the indexes that we chose to analyze were the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, and the New York Stock Exchange Composite. Over on the side here in the gold box, you can see some other indexes that are popular and commonly used. And as you can see, Dow Jones has other indexes as well. There are indexes for transportation and utilities. As well, they have a total stock market return, which is not referenced as commonly, but you can very easily find it. In terms of S&P, they have a 500, a 100, a mid-cap 400, a small-cap 600, and a super composite that contains 1,500 stocks. We'll get more into capitalization and what that refers to in Portfolios 300. Then there are a few others like the Russell 1000, 2000, and 3000. Those are commonly referred to as well. And then in addition to the NASDAQ Composite, they also have a NASDAQ 100 and a NASDAQ Biotech that focuses on biotechnology stocks. Now here is how the indexes performed, and as you can see, for the most part, they're all grouped very closely together. For each of them, they did have the highest return for at least one of the time periods that we tested. We didn't necessarily find anything that really jumped out to us, like the Dow Jones is the highest for year 8, however, it's the lowest for year 1. So really, depending on your strategy and what you're looking at, it's possible you'd want to leverage a different index, but the default in our system is the S&P 500, which is the red line on this chart. And as you follow it, you'll notice that it's pretty consistently average. It's not necessarily the highest at each time period, although it is for years 5 and 15, but it's very much in the middle of everything that we tested. So it should produce a return for you that's consistent with the others. Ultimately, we found that changing the index didn't make much of a difference from a stock selection standpoint. And if you really want to review stock metrics where you can change and adjust to different indexes, well, we do have a system that can do that. Our platform and our reporting does not contain that information, so you'll likely have to calculate it yourself if that's something that you want to reference.